Dear ladies and gentlemen, welcome to the EBI policy series. The EU banking package was published by the EU Commission on the 27th of October. It contains changes to the Capital Requirement Regulation and the Capital Requirement Directive. On its website, the EU Commission says that these new rules will ensure that EU banks become more resilient to potential future economic shocks while contributing to Europe's recovery from the COVID-19 pandemic and the transition to climate neutrality. A very ambitious target about what we want to speak today in more detail. My name is Gstädtner and I would like to welcome you today. A special welcome also our keynote speaker, Martin Merlin, Director at the European Commission in the Directorate D, Banking, Insurance and Financial Crime at DG FISMA. Welcome, Martin. Secondly, I would like to welcome our co-discussant today, Mijs, CEO of the European Banking Federation. Also to you, welcome, Wim. I also welcome here Professor Gstädtner, President of the Academic Board of the EBI. Just in terms of a brief introduction, the Commission proposal can be broken down into three main parts. First of all, the implementation of Basel III. More specifically, the Commission's proposal aims to ensure that internal models used by banks to calculate their capital requirements do not underestimate risks, thereby ensuring that the capital required to cover those risks is sufficient. In this connection, the so-called output floor will be introduced, and we will speak about this later today in more detail. The second point is sustainability. Here, the target is to strengthen the resilience of the banking sector to environmental, social and governance risks. This is a key area of the Commission's sustainable finance strategy. And third, stronger supervision. The proposal also aims to provide stronger tools for supervisors overseeing EU banks. It establishes new fit and proper set of rules for supervisors to better assess whether senior staff have the requisite skills and knowledge for managing a bank. Moreover, as a response to the Wirecard scandal, supervisors shall get equipped with better tools to oversee fintech groups, including bank subsidiaries. Let me now finish with my introduction and now introduce in more detail our two speakers. First of all, Martin Merlin, as I said, Director at the European Commission in DG FISMA. Martin started his career at the French Treasury in the Department of International Monetary and Financial Affairs. He then joined the Commission and since then has worked consistently across various domains of financial services, including positions in the Commissioner's Cabinet, as a head of unit coordinating financial services policy, and as a director of financial markets until his current position as Director, Banking, Insurance and Financial Crime. Martin represents the Commission at the Basel Committee on Banking Supervision, on the Board of Supervisors of both EBA and EIOPA, in the Financial Stability Board and in the Financial Action Task Force. So welcome again, Martin. Secondly, I would like to introduce also Wim Mijs, CEO of the European Banking Federation. Wim started to work at the International Court of Arbitration in The Hague after his studies. In 1993, he joined ABN AMRO in Amsterdam and became the head of government affairs. Between 2007 and 2014, Wim served as CEO of the Dutch Banking Association. In 2014, Wim was appointed CEO of the European Banking Federation. Between 2011 and 2018, he held various institutional roles within the international and European financial and banking community. Wim is also a member of the advisory board of the BBVA Center of Financial Education and Capability, the industry chair of the European Parliament Financial Services Forum, and member of the advisory board of the Leiden Law School, and last not least, also member of the advisory board of the European Banking Institute. Welcome, Wim, to you as well. So with these words, I would like to stop and then hand over to Martin, who will give us an introductory speech explaining a little bit what the EU banking package is about. Martin, over to you.
Thank you very much, Thomas, and thank you to the European Banking Institute for this opportunity to discuss the Basel III package, which the Commission tabled on the 27th of October. I think you summarized the package quite well, Thomas. Actually, but I will try and go a little bit more into the details and also give you the background behind the Commission proposal. Well, to understand the proposal, we have to go back to the great financial crisis of 2008, 2011, which, as you know, revealed a number of weaknesses in the banking system, which transmitted to the rest of the financial system and the real economy, resulting in massive contraction of credit and liquidity. In response to that, between 2010 and 2017, the Basel Committee on Banking Supervision agreed a number of very substantial reforms of the prudential framework for banks to enhance their resilience, increase financial stability, and provide the basis for a sustainable funding of the economy. This is the so-called Basel III framework. In the EU, we adopted legislation already to implement some of these reforms. However, a number of the final elements of the so-called Basel III framework adopted by the Basel Committee back in 2017 still need to be implemented. And as you know, the target date for adoption internationally set by the Basel Committee is 2023. Now, the objective of the outstanding Basel III reforms mainly twofold. First, improve the overall balance between simplicity, comparability, and the risk sensitivity of the framework. So the work focuses very much here on the denominator of capital ratios. And second, the goal is to restore confidence in risk-based capital requirements, improving the solidity of banks, notably by addressing identified deficiencies of internal models, some of which turned out to be undercapitalized and fragile during and after the crisis. And also through enhancing the risk sensitivity and robustness of the standardized approach to provide credible alternatives and backstops to internal models. Clearly, this is an important reform in general, but it is particularly important for the EU, given the EU banks' high reliance on internal models, but also given the high number of small and medium-sized banks that we still have in the EU and which usually rely on the standardized approach. In order to come up with a balanced package of legislative proposals, the Commission had to find an equilibrium between different political objectives. First, of course, we want to implement Basel III faithfully, because we think that on the whole, this is a reform which is going to be beneficial for financial stability and for the ability of banks to finance the economy in the long run. We needed also to take into account certain European specificities. The Basel standards are agreed upon at international level. They cannot always cater for the specific ways in which economies are financed by banks. across jurisdictions. So we needed to bear that in mind while developing the proposals. There was also the request to avoid a significant increase in overall capital requirements coming from the G20, coming also from the ECOFIN Council and the European Parliament. The feeling being that a lot was done to bolster the capital positions of banks already since 2010. And also there was the desire not to hamper economic recovery in the present difficult economic circumstances. I would add to that we wanted to use this reform to also try and reduce compliance costs further. And also we needed to draft the proposals bearing in mind the home host balance between different member states in the banking union. So before I sketch out the main elements of the package in a very concise manner, one word maybe on the capital impact of the reform as set out in the impact assessment that we have published alongside the legislative package. Our estimate is that the long-term capital impact would be for our sample of banks between plus 6.5% and plus 8.4% in minimum required capital. So I would say around plus 7% on average for European banks, which we think allows us to meet this, demand to avoid significant or at least very significant increases in capital for the European banking system. That said, of course, this is an average, and the distribution between banks needs to be looked at as well. On the whole, we believe that increases in capital requirements will be very low and negligible for the vast majority of banks in the EU, especially small and medium-sized banks. But as a result of the introduction of the output floor, capital increases may be quite substantial for some of the GSIBs operating in the EU. Now turning briefly to the main elements of the package, I'll start maybe with the output floor, which has been the subject of lots of controversies over the last few months and years, given the impact that it has on some of the European banks. We have chosen to apply the output floor as decided upon in Basel, namely as a single stack. And of course, we set it at 72.5%. So this is, we think, the right way to go about this, the way which is faithful to the agreement reached in Basel. That said, given the major impact that the output floor can have on some of our banks, we attach to it three transitions. One on in relation to exposures to unrated corporates, where we allow banks to maintain internal models approaches until 2032, where we think we should move towards the full Basel treatment. There is a transition also for low risk residential mortgages, with a number of conditions that need to be met. Here, risk weights would go up gradually until 2032, when the output floor would be fully applied in this respect. And a third transition has to do with derivative exposures calculated under the standardized approach for counterparty credit risk. This is also a major driver behind capital requirements, and we have opted for a smooth phasing in this respect until 2030. And the overall output floor would be implemented between 2025 and 2030, giving, I think, banks enough time to adjust. Another major pillar of the reform is, of course, the revision of the credit risk framework. Here, we basically take on board the Basel reform, but we also provide for some EU-specific adjustments, in particular in the area of specialized lending, which is particularly important in Europe, where we propose a more granular treatment than the one envisaged by the Basel Committee, notably for project finance and object finance. And next to this, we also try and use the flexibility embedded in the Basel standards to avoid penalizing long-term investments in equities. And we also provide grandfathering of strategic holdings in equities. I open a parenthesis here. I want to mention the fact that we have made the choice not to put into question decisions taken recently by the European legislator. So what we do is to take on board the Basel standards in a very faithful and largely compliant way. We give ourselves a bit more time to implement the new framework. Instead of starting in 2023, we propose to start in 2025. We have some transitions that last a little bit longer than that. And we also maintain certain deviations decided upon by the legislator fairly recently, for example, in relation to the SME supporting factor or to the infrastructure supporting factor. And we'll see what the European legislator wants to do now with those. I close the parenthesis. Another major pillar, of course, is the fundamental review of the trading book, which we propose to implement fully. So turning the existing reporting requirement into a capital requirement. That said, here we need to be particularly vigilant to see what other important jurisdictions do. So that is why we propose an empowerment for the Commission to potentially make changes to FRTB or to delay the introduction of FRTB in the EU, depending on what other jurisdictions do or do not do. We implement the new and final CVA risk framework on credit value adjustments. Again, here keeping the exemptions of certain transactions from the capital charges under Pillar 1 as decided not so long ago by Council and Parliament. We take on board the new operational risk framework, which, as you know, does away with models. And we have decided to propose to use the discretion allowed for by the Basel Committee to disregard historical losses. Of course, taking into account historical losses allows probably for greater risk sensitivity. That said, it was also a major driver behind increases in capital requirements, and therefore on balance we have chosen to go for the use of the discretion to disregard these historical losses. We'll see now what Council and Parliament want to do about this. And finally, and importantly, as I said, we propose a general application date set on the 1st of January 2025 in order to take into account the length of the legislative process, in order to also leave enough time for banks and supervisors to implement this new complex framework. And I have to say, I would be surprised if all major Basel jurisdictions would be on time in January 2023, but we will see that. Now, before closing, a few brief words on other elements of the package. This package, as Thomas said, is not only about Basel III, it is also about trying to improve legislation in general. So we make proposals on proportionality to reduce the administrative burden, especially for small banks, using synergies via centralized disclosure, and also increasing the simplicity of the framework in line with Basel III. We propose the introduction of requirements under Pillar 2 and Pillar 3 to better address ESG risks. So we expect banks and supervisors to monitor the evolution of these risks better, and in particular climate-related risks, with the possibility for supervisors to add under Pillar 2 capital add-ons if they consider that banks do not sufficiently well mitigate climate-related risks. We propose a minimum harmonization of supervisory powers, including fit and proper assessments, and also of sanctions, administrative penalties. We propose a proportionate minimum framework for the regulation and supervision of third country branches, some of which can be quite significant and even systemic. So here we want to make sure that there's a minimum level of regulation across all member states, and we also want to make sure that the SSM can have access to the information it needs in order to assess the risks that may derive from these third country branches. And finally, we have made a separate narrow proposal in order to address problems of interactions between the prudential framework and the resolution framework, in order to, in particular, operationalize daisy chains for capital and MREL purposes. And also, we propose some adjustments to the provisions applicable to banks using an MPE strategy in the area of resolution, and we hope that those can be adopted swiftly. So I'll stop here. The negotiations have started now in council especially, and they will soon start in Parliament. I think the gist of the initial reactions is that this is a balanced package, well thought through. But of course, we will have in 2022 an exciting year of negotiations, both in Council and Parliament. The incoming French presidency hopes to strike a political agreement in June on that. It's going to be difficult, but it's possible. And this may lead to a final agreement towards the end of 2022, which would give everyone 2 years in order to be prepared. I'll stop here. Thank you.
Thanks, Martin, for this very comprehensive explanation and description of this new package. I mean, you have been working on various packages in the past already. And if I may ask before we hand over to Wim, you described a little bit also what are the next steps for the implementation of this, but where would you expect the biggest discussions when it comes to the implementation of this package from your experience in the past and the discussions in before the publication of this draft?
Well, for sure, there will be difficult discussions around the output floor. We have proposed to implement the output floor at consolidated level only, because we think that this is, the most European approach to the matter. Nevertheless, with a redistribution mechanism in case there are capital excesses, which could be redistributed to host member states. But we know that this is problematic for many host member states, which want to apply the output floor like the capital, liquidity, and MREL requirements at all levels of the bank. That is bound to be difficult. I expect still in relation to the output floor, delicate discussions on the transitions that we have put forward on unrated corporates and low risk residential mortgages in particular, with some member states pleading perhaps for these transitions to be made permanent and for these deviations to be made permanent. We understand, of course, where they would be coming from, but clearly that these would be then major deviations in relation to the Basel package, which could be problematic. So these are examples of points of discussions.
Thanks, Martin, for this hint on the discussions we can expect in the next year. I would like now to bring in Wim, who is looking into this package, obviously, as CEO of the European Banking Federation, representing the European private banking associations. And Martin already hinted that some of the GSIBs will probably be more affected than the 7% in the average. So I guess you also have a very strong view about one or the other point in this regard. And I would hand over now to you, Wim, for sharing with us your views. Thanks.
Well, thank you very much, Thomas, and thank you very much, Martin. A strong view, say this was anyway going to be a difficult journey. And if I look at all the discussions after the 2016 no significant increase announcement until now, I must say I very much appreciate the balance that was sought in the banking package. Of course, there are parts of it which I'm seriously concerned, but what I do like is that there was a very clear attempt by the European Commission to get everybody aboard, the banks, the member states, but also to stay Basel compliant. Now, if I may start by saying that I do believe, like the European Commission, in international agreements. And so if we have an issue with the result of the Basel negotiations, we should go back and maybe on Basel IV in future organize ourselves differently. But we have a package that needs to be implemented, and the decision was to stay Basel compliant. So it is what was very interesting. And we thought personally, and now is my first part, we have been pushing very hard for this so-called parallel stack approach. Because in our view, to stay Basel compliant, one of the ways in which we try to do this in the calculation was, okay, let's go back to the original agreement of Basel and go and implement that with the output floor as agreed. And let's then look at the European gold plating, if you want, or the extra measures done mostly by member states, and take that out of the calculation. Now, I understand the reasoning of the Commission that this was not chosen. However, we thought it was a very elegant solution to keep the balance between, on one hand, being Basel compliant, and on the other, taking care of some of the extras and the complexity that you have if you're with a large group of member states. So, but we do appreciate that the Commission took on board some of the concerns, because they were between a rock and a hard place, in my view, the last minute letter by many central banks was very interesting. I would like to congratulate the central banks on the lobbying prize of 2021, because it was well written, well timed, and it was seriously interesting. But you see that there are certain specificities which the Commission took on board. If you look at the fact we are in a bank finance economy, we are in a post-recovery or in a recovery phase. We have huge challenges to ahead of us to come to a greener, more sustainable economy. And I thought that balance was well struck. Now, if I look at some of these things, we appreciate also that the Commission took a long lead time, especially for the unrated corporates. And as I always say, we're not talking about small SMEs here. We're also talking about IKEA. So if you look at unrated companies, there is sufficient time, or there may be sufficient time, to design a system of rating going forward until 2032. For mortgages, this is a big problem. The low risk, bigger problem, the low risk residential mortgages, and many of the countries who have these, I am from one of these countries, the Netherlands, for instance, but there are others as well, will of course argue that low risk residential mortgages will still be there after 2032. So that is one of the parts where I expect a lot of discussion going forward. I also appreciate the risk that the Commission took in keeping the SME supporting factor in. I think it's important, and it shows very much how we finance our economy. But on the other hand, we have heard the sound or the noises coming from Basel that this was actually not fully Basel compliant. So in my view, one of the things that Martin says in these is that's why we mostly Basel compliant. So all in all, the package is quite balanced. What I do worry about is again, and that is again the characteristic of the way the European Union works and the way our legislative process works and the way the Lamfalussy or the La Rosière levels work, is the level of complexity that we can expect from this. Because as rightly as Martin says, it is always a balance in a good prudential framework to have a balance between simplicity, comparability, and risk sensitivity. And I think that in if we go and ahead in implementation, one of the worries that I have is complexity. Now, also on going on, and there are many more things to say, but I don't want to dominate, because I think it should be a dialogue as well. But also looking at proportionality and the proportionality, I do believe that the proportionality is well recognized and well struck. I am a firm believer in what the Commission said earlier, is there cannot be a compromise on capital requirements for any banks, big or small, because you can say too big to fail, but you can also say too many to fail. And the lessons from 2008 showed us that both can be the case. Of course, one of the things in the complexity is that you do need to look at the reporting and at reporting requirements and compliance requirements for smaller banks. So I appreciate very much the opportunity that the Commission has taken to try and simplify, and I must say the SSM does the same, to simplify, not in capital adequacy, as should not be done, but to make a simpler framework for reporting and bundling reports and disclosure, because I think that will be a real help. Finally, for me, 2025 is a realistic date, because it takes into account the legislative process that we have here in Europe. And I appreciate that they've taken that on board. And I do agree with Martin that I am very interested how these other jurisdictions will be able to implement by 2023. So I do agree it will be interesting to follow this, and I think it's good that the Commission has started the process relatively early, because that also sets a standard for others to follow. So I'll stop here. There are many more things to say. The discussion points, as mentioned by Martin, are indeed in my view the ones that I foresee as well. There are some more on complexity, but also on branches, which we're still studying, because indeed what we do want is to be open for business for foreign banks and not complicate, because at global standards, what you serve is what you get back. So the reciprocity there is important as well.
Wim, thanks very much for this opening remarks. And then now looking at the time, we have now around about 20-25 minutes for Q&A session. To the audience, we also have a Q&A tool, so you may ask your questions also via the Q&A tool. And if they suit into the discussion we're currently having, I will read them aloud and then we'll direct them to the two speakers. But let me start first of all with one question to Martin, because the package, the EU banking package, obviously is based on the Basel III package, which was agreed a few years ago. But Basel is essentially not binding. Of course, it's something all member states agree and the community agrees to implement, but it is obviously not binding. But what do you see as the biggest differences between the Basel III package and the EU banking package as proposed by you right now?
Well, as I said, this is a broader package. We take on board all outstanding elements of the Basel III reform, and we transpose them into European law, but we add a number of EU-specific reforms, be it on proportionality, on third country branches, on ESG risks. So that's one difference. And then in terms of, deviations, so to speak, in relation to the Basel package, well, one difference has to do with the timeline. We propose to start in 2025, not in 2020. And then we maintain, as I said, a number of adjustments decided upon by the legislator a couple of years ago. And then we have very specific, and targeted adjustments on, holdings of equity, on in relation to financial conglomerates in particular, on specialized lending, as I said, on unlisted equity, where we think that we need to make small adjustments to better cater for European specificities. But again, these are very, very circumscribed. And for the rest, we apply the Basel standard faithfully, albeit giving ourselves a little bit more time, as I said, with a few transition arrangements.
Thanks, Martin. I mean, one of the points that you already hinted in the discussion, and Wim was responding to this, is the so-called output floor. Yeah, so there were various models discussed in the lead up to this proposal, to this draft, and one of the proposals was obviously this parallel stack. Yeah, you finally decided against this, and you mentioned this would not be compliant with the Basel requirement. Yeah, can you elaborate a little bit more on this and why you decided? Was this the main reason, or did you also decide against this from a prudential perspective, or what was the reasoning behind this? And I would also be interested in Wim's opinion about this.
Yes, well, first, I think the Basel standard says that the output floor needs to be applied to the whole capital stack of a given bank. So that's a fairly simple and straightforward way of putting the matter. So in our view, this points towards a single stack. Next to this, the parallel stack would have introduced a lot of complexity with the need to compare two very different capital stacks, which we think would have been at odds actually with the reform. And it would have brought us back to the previous output floor, because actually there is an output floor already. But it is not really, applied and respected. So that would have brought us back in history. And also more fundamentally, as it was put forward, the parallel stack would have basically neutralized the impact of the output floor, leading to a situation where one of the two main elements of the Basel III reform would not have had a material impact. This, in our view, was really against the spirit of the reform, and that's why we went for the single stack approach, which is seen by the vast majority of the regulatory and supervisory community as the right way to implement the output floor. So that would be my reaction in a nutshell, and without wanting to be too long on that.
Thanks, Martin. And then handing over to Wim. I mean, you or the industry was very hard pushing for this parallel stack, and you also hinted that in your view it would have been compliant at least with some earlier versions of the Basel III Accord. This was not achieved finally, yeah? So what were your arguments when you were pushing for this parallel stack? Also in reply to what Martin was just...
Well, I said it a little bit in my introduction, is say both the European Commission and we were faced with the negotiation result from Basel, in which we had the 72.5% output floor. So that means that you try to find solutions. As I said, it's first you start looking at the European economy and realizing that it is a bank finance economy. And also then to the consequence to banks. It's what Martin also said, some of the GSIPs are pretty hard hit. So then you start to try to get creative on how can you be in alignment with Basel on one hand, and how can you deal with the specificities of the European economy on the other, and how can you also deal to the extra measures, that's at least how we feel it, that are sometimes introduced in Europe and mostly by member states. And that led to this creativity, and I call it a creative solution. And again, as I said, I also mentioned it an elegant solution, but I do understand. I was, to be honest, less impressed by the letter of the central banks. It was kind of expected, also in the view of who sent it, and it was I thought, very much aimed at one way or the highway. But I do take the solution that the Commission has chosen. I see that in Martin's answer, also to look at residential mortgages, to look at non-rated corporates, there is, in my view, it is clear that the Commission took on board some of the standard arguments that we had. They just came to another conclusion. So I appreciate that. Now, on casting the ball back on complexity, there I have to agree with Martin. If you had two stacks, it would have added complexity. So I would agree. What I would less agree to, in our calculation, in our view, we never had the intention to neutralize the impact of the output floor. So in our calculation, in our view, it would have been Basel compliant, and it would have led to an adequate level of capital. But again, I accept the conclusion. It was creative thinking, but now it's important that these European specificities that the Commission has highlighted, that they are implemented in a way that which work with.
Thanks, Wim. Then staying on this topic of the output floor, one of the points that you were also mentioning, Martin, was that you are applying, or the idea is to apply this output floor on the highest level of consolidation only, which obviously is, if you look at the European Banking Union, and particularly the SSM, as a key element of such a framework, yeah. But this is probably not all member states are happy about this. Can you explain, first of all, how it should now work within this current framework, so we can get a better understanding of what it would mean, and where would you expect the pushback? And then also to Wim, what do you think about this application of the output floor on the highest level of consolidation only?
First of all, an important element on the output floor is, in general, is that we do not want the output floor to come on top of Pillar 2 requirements, which may be in place right now in order to cater for internal models risks. So there is a clear demand in the draft legislation addressed to the supervisors to remove Pillar 2 requirements when they are there to cater for risks that may stem from internal models, so that we don't have a double counting. So this reduces, of course, the impact of the output floor in comparison to the present situation. When it comes to the level of consolidation, well, we went for the approach which, number one, was the most European approach to the matter, and we have to recognize that it is not easy right now for pan-European GSIBs to operate throughout the EU. There are not many incentives in terms of capital, liquidity, and MREL to be operating in different member states. Whilst we, of course, perfectly understand the concerns expressed by host member states in relation to the subsidiaries established in their territories, we think it is important, to also recognize the role that these pan-European banks play, and maintain enough incentives for them to operate in different member states. That's why we went for the most European approach when it comes to the implementation of the output floor. At consolidated level, it would be calculated at consolidated level. Nevertheless, with a redistribution mechanism to host member states in case there are, so to speak, capital excesses resulting from the calculation at consolidated level, because we do not want to deprive host member states from the capital that they may need at subsidiary level.
Wim, then I would hand over to you.
Well, again, I can't argue against the European approach, because that is what I favor as well. And if I just concentrate on the choices made, there is a logic in the reasoning there. If you agree again, if you follow the route of thinking that the Commission has followed, I can understand why they went for the consolidated level. Now, but concentrating on pan-European banks, and as I said, there's quite a number. There have even been regulators and supervisors who are asking for pan-European mergers. And if you look at that, indeed, that this all comes down to the cost of capital. So Martin has the right point there. And what I find still very strange is that even after the banking union, we still have some strict capital limits to free flow of capital and liquidity. So to try to tackle that on one hand, and on the other hand, cater for the worries that some of the supervisors have, because this is trauma that goes back to 2008, when they literally saw money leave their country without having any instrument to do anything about it. I can see. So I must say I can follow this line of reasoning very well.
Very good. Then one point, Martin, you said kind of as a additional tool, European specificities of this package are that you have introduced transitional arrangements, for example, for low-risk mortgages. Yeah. Does it mean basically that you consider the developments in the residential real estate market as a low risk at the moment? I mean, there are some NCBs actually highlighting also the risk piling up in this market, obviously more in the commercial real estate market, but also in residential real estate, where they say that properties are overvalued, for example, here in Germany, 10 to 30%, as mentioned by Bundesbank. Would you see this a little bit contradictory, or how would you see this development? And the other question actually would attach to this right away is, I mean, these transitional rules obviously have also been pushed hard for by the industry. Yeah. So the idea is to phase them out by 32, as you mentioned. Yeah. Do you think there's going to be a strong push to make them permanent?
Yes. Well, on this transition under the output floor for low-risk residential mortgages, one very important point here is that this is only a discretion left to national supervisors. They may decide to activate it or not, and we expect the vast majority of national supervisors not to activate this transitional arrangement. There are in particular 2 or 3 member states which are very interested in that. So that's already a response to your question. In a way, we do see in some places residential mortgages heating up. This is a cause for concern. Therefore, we see the case for this transition to be activated only in those markets where it is safe to say that there are no reasons to worry about financial stability and the stability of these markets. And we have to recognize that these are markets which still differ a lot between member states, with probably cause for concerns in some member states and less so in other member states. But we certainly see risks in this area in general. Yes, and on to your second point, I think I responded already. Yes, there is the possibility for some member states to plead for these transitions to be made permanent. But we think that this would not be the most sensible approach from a prudential standpoint, and this would really put us at odds with the Basel Agreement and the international regulatory community.
Thanks, Martin. Maybe because there's now a question in the Q&A tool, I would like to ask this because it also fits quite well into the transitional arrangements. One is for unrated corporates, you mentioned, Martin. So the question is from Andreas Rolke from the Ministry of Finance of the German state of Hessen. So how does the EU Commission envisage the handling of unrated corporates after the transition period has expired? Will or must there be a rating for all companies afterwards?
Well, certainly we have to develop a rating of mid-sized corporates in Europe before moving to the Basel treatment. We think this would bring benefits from a prudential standpoint. It will also bring benefits from a market-based finance standpoint, and we do see the development of ratings as useful in the CMU context. We have some time to get there because this is a transition that ends only in 2032. But to be ready in 2032, we have to get our act together quickly in order to develop these ratings. I understand there are ideas around banks data pooling, which is something that could be explored. There are ideas also around using data available in central banks, and in one member state in particular, there is rating carried out at the level of central banks, so that can also be a source of inspiration. So we will need to work on that, indeed, to develop more ratings and to avoid a cliff edge risk at the end of the transition period. So there is some collective work that needs to be done on that quite clearly. Does it mean that all corporates will need a rating? We have to see, certainly not all corporates, but if we want the Basel treatment to work, certainly a high number of mid-sized corporates should have one in due course, yes.
Thanks a lot. Wim, let me know when you want to step in on these 2 points, so residential real estate and unrated corporates.
No, very, very shortly, residential real estate. Well, to residential real estate, I do expect some discussion. As I said, it was very clear what Martin said. This is up to the member states, and you see that in some member states, this is very much a long-term arrangement. So you can see that going forward. On the other hand, indeed, it is important to look, and I see this as very much the area of macroprudential for bubbles in the housing market, because if you look at the macroeconomics, it's quite logical that in some areas you see the possibility of bubbles arising. But I see this as certainly something that will be discussed further. Now, on unrated corporates, I do appreciate the long lead time. I think it's important that we have a long lead time, but it also may be beneficial. The way Martin is now suggesting it is actually beneficial, because we have some the lack of data in for the further progression in the capital markets markets union, and there are good reasons also to stay within the in the prudential framework. Nevertheless, it's as Martin says, it needs to be we need to start early, give us really some time, and get together. This can never be a regulatory decision only. It needs to be market based, and it needs to work in the market. So indeed, I like the sources of inspiration, although I always get a little bit nervous when it is suggested to do bank data pooling, because that usually involves costs and complexity. But nevertheless, I'm very open to discuss this at an earlier stage.
And let me ask one question also on the regime for third country branches. This has been changed, as you mentioned. So first of all, why was this necessary, and what exactly are you changing right now? And then if you look now at the treatment of branches of EU banks in third country markets, what is the difference? What do we see there? And what do you expect to be the reaction on your proposal in third countries?
Well, we don't propose to go much further than what third countries are already doing. If you look at the UK or the US, where I think subsidiarization is a tool available to the supervisors. Now, we propose something which we think is very proportionate. For the moment, we have a regulatory patchwork, very different rules applying to branches in the different member states, with a risk of regulatory arbitrage. So we want to bring some order into that, making sure that all third country branches have to abide by the same minimum requirements in the EU. And we also want to make sure that the SSM has access to all the information it needs in order to, determine notably the systemic relevance of these branches. Some of them are very large indeed, and for the moment, the SSM probably does not have all the information it needs in relation to those branches. So we want to make sure that this changes. There have been discussions around subsidiarizations. Frankly, this is something that we see as a last resort only. We see the value of having branches in Europe, including large ones. And we see subsidiarization really only as a last resort if other measures fail, or if the branches are hugely systemic. But this is only one tool in the toolkit.
Thanks very much, Martin. And then looking at the time, we have now 2 minutes. Maybe I ask one more question on the other element of your proposal. And this is about the field of climate and environmental issues. This has become more prominent now in the last years. The ECB is doing also quite a bit on this now in its supervisory approach. Next year, there will be even a stress test on climate and environmental issues. How do you exactly address this point in the current package? And then maybe more specific, in the past, there were also discussions about a green supporting factor, to support also from a capital perspective, investments or exposures which are considered green. Has this now finally been introduced, or are you still thinking about something in one of your next packages?
Well, first on that specific point, we do not propose a green supporting factor or a brown penalizing factor. We think we still need to do more work on the subject, and that is why we are asking EBA to produce a report on the subject by 2023. If we go for such a factor, we need to do that really in a way which is evidence-based, which remains prudentially solid. And we did not have the right evidence and data to do that in the Commission. So more work will be needed in this regard. But I expect, of course, this to be discussed in the co-decision process. So on that, we wait until the EBA report in 2023 and we'll take it from there, subject, of course, to what Council and Parliament decide. On ESG risks in general, yes, we do want to work on a better integration of these risks into the prudential framework. This has started with the last banking package. In the sustainable finance strategy adopted by the Commission in July, we announced a number of additional measures. We are tabling these measures now with the introduction of requirements for banks and mandates for EBA on the integration of ESG risks in risk management and governance, with the requirement for supervisors to ensure that banks manage ESG risks adequately, including potentially by making use of dedicated supervisory powers. And also we want to integrate better ESG risks in supervisory reporting and extend disclosure requirements to small banks in this area, subject to proportionality. So this is what we propose in a nutshell on that topic.
Thanks a lot, Martin. Wim, maybe to you, from an industry perspective, how do you see this development and the feasibility of this from a bank's perspective?
I see it actually as a little bit as two different topics when you talk about the green supporting factor. So I will first react to the package, and there's no doubt banks are essential, in my view, for the transition to a net zero or more sustainable economy. This is what we saw in Glasgow, and that's really what we presented in Glasgow. Now, the easiest way forward for a bank, if it wants to be the green bank, of course, is to kick all clients that are even a little bit brown or dark green from their balance sheet and then declare their own balance sheet to be carbon neutral. And in my view, this would be the worst approach possible. So I do appreciate very much that you need to take into account, and so if you clearly follow what's happening in the economy, but also the emergence of climate risks and ESG risks, I very much support creating a prudential framework to measure these risks. And I appreciate the work that's being done by the SSM, by the ECB on this. So on that, I completely agree. Now, your green supporting factor very much goes into the how, and how do you stimulate this transition economy? And I find that a little bit a topic for another debate or another seminar, because you can talk for hours about that. I think that personally the green supporting factor or brown penalizing is a bit too simple, as I said, but you need to really get to the transition. For me, it is incredibly important that banks play their role, first by measuring, by realizing the risks, but also by helping their clients go to a net zero or sustainable way of production.
Thanks a lot, Wim, for this. We are also now 4 minutes past 1 and at the end of our policy series. So I thank both of you, Martin and Wim, very much for participating in this discussion today. It was also the last one before Christmas. So I wish you and also the audience a Merry Christmas and all the best for the new year. And we see each other again next year. Thanks very much and bye-bye.